Good afternoon, everybody, and welcome to this evening's or this afternoon's trade review session. So it's been a difficult week. I've had a couple of very difficult days, Monday and Wednesday. A large number of trades stopping out. Some significant losses on Monday, which I've done my best to pare over the course of the week. And have reduced them probably by about a factor of 50% over the course of the week, but still a negative week. So thankfully there haven't been too many, but it's always, this is kind of a conversation like when you're younger and you're waiting to go in to see one of the head teachers because you've done something wrong. It has that sort of feel about it. So it's a negative week. You have to expect that from time to time, unfortunately, and it's about how you react to it and how you move forward from there. So you will bring up the charts or the results in a few minutes, and we'll talk about those in a little bit more detail. Markets at the moment, we do seem to be reasonably range bound, bumping into resistance up above 28,350 on the Dow. And some support coming in when we go back down and test the 28,100 level. The one thing of note this week, I suppose, as much of the ranges have been reasonably tight, we have had some big intraday movements, but the range hasn't expanded out to 800-900 points. Everything has been conducted in this 400 to 500 pip range that we're in at the moment. But the moves are quite sharp and quite damaging when they do occur, and there have been a number of those during the course of the week, and there were a couple yesterday as well. Thankfully, on the moves yesterday, they were in our favour. So there's a good few questions coming through. I encourage the rest of you to ask questions, and I'll do my best to answer them during the course of the next 20 minutes or so. I'm enjoying some of the questions already, so we'll see where they go. And just one of the followers this week reminded me of a saying, what's the difference between trading and peeling an onion? And the answer was peeling an onion doesn't make you cry. So trading does. And I felt like that on a few occasions during the course of this week. So we'll talk about that in a bit more detail anyway. Obviously, everything ongoing at the moment, a lot of it is election focused. It was the last debate between the next or one of the next great leaders. Whether that's Trump or Biden, I don't really have an opinion in regards to which one it should be. I think Trump is probably more exciting for the market, so that's probably where my preference lies, but it's not because of the person, it's just because of the volatility that he brings with it. Gold has fallen off. I've been short gold today. Unfortunately, out of those trades a little bit too early. But there is a different feel about the markets this week, and whether it is just pre-election positioning, it's been difficult to get hold of moves. Did get one or two yesterday, a very early move this morning as well. So those have been nice, but they've been few and far between. And as I've mentioned already, there've been far too many stops during the course of the week. So if we look at the results for the week to date, you can see the devastation that was Monday. 1,208 points to the downside, 535 points again on Wednesday, and then 3 days. Tuesday was a very good day, every trade profitable. Yesterday was a very good day, just the one stop very early in the morning. Part of that was a bit of a panic about the two positions that I carried overnight, the 340 pip loss and the 374 pip loss that you see there on Wednesday. The context of that 130 pip loss, it wasn't a particularly good stop. Was towards the low that we saw yesterday, but in the context of the positions that I'd carried overnight, that's really where not necessarily panic, but a bit of prudence kicked in, and I thought I'd better close out that position as well. Otherwise, yesterday would have been significantly more profitable, and the end of week result loss of 678 pips. If you hark back to the previous week's profit, it makes a dent in it, makes a really good dent in it, but on the month-to-date numbers is something that can be taken. Not something that I want to encourage, but it's something that can be accommodated within the results that we've seen to date so far. But just going back to Monday, and Monday was a very bad day. Now the sheets look like there's been a lot of over trading, the grey line being my watermark, if you like, for that over trading scenario. A lot of smaller trades, certainly late on the day on Monday, and then there have been a number of smaller trades during the course of the week as well. But lots of things going wrong on Monday, a number of stops. So anything above 100 points is a stop, so that's 1, 2, 3, 4, 5, 6 stops. Should have been a circuit breaker for me personally prior to getting to that stage, but got overexposed, too many trades on at one time, and then as the market fell away, as much as I was hoping for a recovery, there came a point or points where stops did need to be taken or did need to be executed, and I think they occurred in 2 different batches, the first 2 batches, and then the last 3 all together as well. But there are some slight anomalies in trade size there as well. Wednesday, similar sort of thing. 2 trades carried overnight to the DAX and the Dow trade, both quite small trades, but carried overnight, and significant losses when those stops were eventually taken out early in the morning on Thursday, combined with that stop that came in on Thursday. But trading around those, and this isn't this is no way compensatory, but the trading around those days on Tuesday, Thursday and Friday has been exceptionally good. So one of the phrases that I often use is making sure that you trade the conditions. I think the conditions have changed a bit over the course of the last week, and Mondays have never been kind to me, and there needs to be a different approach to Monday, and rest assured there will be a different approach this Monday morning, because I'm not going through that again personally. And then on the other days have been far more in tune, bar Wednesday, where I got caught on an overnight trade. And again, going back to the things that I try to encourage you to do on a daily basis is, if the number of stops exceed 4, stop. Don't carry trades overnight. So there were 2 very blatant breaks of my own rules during the course of the week, and subsequently I'm paying for them at the end of the week with a negative balance. So I have 1 trade open at the moment. It's roughly it's a small trade, just to see if we get any upside into the latter part of the trading day here today. I do think there is some chance that we could see developments on the stimulus package, and positive developments. I think today is probably the last day that we have a chance to see that. So I'm happy to keep some small position open there. So going through these questions, I'll start with the last one, which is from Christopher. Telegram notifications don't show stop loss positions. Do you set stop loss points on your trades? The answer, as you can see from those screens I showed you a minute ago, Christopher, is no, I don't. Again, in terms of trading the conditions, I think your stops should be proportionate to the volatility that you're seeing in the market at any one time. In my head, I have notional stop positions for every single trade that goes on. I think we've publicised or we've published these and made note of them a few times during different conversations. So 200 points on the Dow, 100 points on the DAX, 100 points on gold. So those are where they are at about 75% of those levels. The traffic lights start coming on in my head, and I'm appraising what I then think about the market for the remaining 25%. As my position changed, am I still looking for the market to move in the direction that I initially put the trade on, or do I need something to do about it? And then at somewhere between 100, maximum of 110% percent of the stop, the notional stop position, then I'm looking to execute the stop. But always in my mind, every stop that I place, I'm not a robot, so it's not everything is automatic and full and final. So it's very much a case of seeing the market, seeing the conditions at that point, reappraising it, and do I want to trigger? How far would I let a stop run? I think somewhere in the 250 to 300 point range on the Dow is the maximum that I would like to see. I know that on the trade sheets this week you have two bigger losses than that from a pip perspective, but the size of the trades were a bit smaller, so I don't think that's necessarily an example of exceeding those particular limits. So answer to the question, I don't stop. I don't set stop loss or TP levels. I think every trade is different. I have a target. My first target will come in around 25 to 30 pips. But if there is momentum in the trade, I obviously would like to run it as long as I possibly can. If there is no momentum and the move is starting to peter out, I'm a firm believer that you're better to take some profit than no profit and just let the trade witter away. So Fly Smith, any tricks for regaining composure after a big stop hit? It's a tough one. Obviously as the stops are getting close, the first thing that you do lose is composure. But there are various analogies or similarities that you can come up with, and I don't think any of them are completely accurate, because we're talking about money here and your own money. And we all enter trades expecting to make money or to win, and admitting that we're not winning or that we're failing or we're losing money is a very difficult cross to bear. So it's important that you get used to it, number one, and I think you do become more immune, and it is a function of the business that you're trying to do. It's a consequence of everything, or it's a potential consequence of every trade or every day as you're doing things. So the easier you can, or the quicker that you can become used to that, the better it will become. 30 plus years at this, still don't like taking a loss, but you realise that it can be very damaging if you don't do that. I think that's why a lot of people blow accounts. They expect the trade to come back, and it gets worse and it gets worse, and eventually it gets so bad that there is no option other than to persevere with the trades. So Donal, Nick, if you're in profit on a £10,000 or euro account, do you take profit end of week or keep rolling it over? Again, personal preference, I think, is you take profit. I think sometimes when you roll it over, encourages more risk, and I don't want to do that. I think and I still don't want to do that 30 years on. I think you, once you're in a situation that you're comfortable with your risk levels, and your risk levels and your trade exposure are giving you enough exposure to realise or to potentially realise the profit margins that you're looking for, I see no reason to escalate. So my trade size stays fairly consistent. For those of you on duplicate trade, you'll see that the trades, and this was something I wanted to talk about, because we're the trades that or the executions that you're seeing coming through on Telegram are coming through from the duplicate trade account. So the standard lot size is 0.25 of a lot, and a small trade is 0.16. So if you see that on your Telegram channel, rather than me following up rather slowly with a notification that it's a smaller trade, the lot size will indicate whether it's a smaller or a larger trade. So 0.25 for a standard trade. And then sometimes I'm 0.16 or 0.14 for a smaller trade, so a little bit more than half, but obviously trying, and sometimes that's when I'm trying to get the feel of the markets back as well, as after Monday, when took a fairly big hit and then was easing myself back in from there. So there's another quick question from Fly. I wonder how you set position size, for example, a formula of lots per... Everything goes back to the maximum exposure per trade. On a £1,000 account size, your maximum loss on any trade should be no more than 50, whether that's pounds or dollars. Ideally, you keep it a little bit tighter than that. It's down to 30. And then if you have 3 or 4 positions on, which tends to be my quorum, if you like, in terms of the number of positions that I have open, then you're looking at a 12 to possibly 15% maximum exposure. So if you have a day like Monday, then your exposure, and Monday was worse than 15% because I got stopped out so many times, you're looking at a loss somewhere in the region of 20 or to the low 20%. Now that's an exceptional case. For me, most of my trades come in at around a 5%, 5% in terms of the maximum monetary exposure on the individual trade. So my maximum daily exposure should be somewhere in the region of 20%. If I step outside of that, I've moved my stops, or the stops have been considerably bigger than I was anticipating. So questions from James. Is there any slippage that you've noticed since DupliTrade started? The honest answer, James, is that I can't see, because I execute in a master account. So when you get the trade notification on Telegram, that is coming from the DupliTrade master account. So if you get a feel that is slightly different, then there is definitely slippage. Now, I know one of the people that used DupliTrade did a trade by trade reconciliation last week, and there was discrepancy, and I don't know how many trades there were, but say there were so it's 3 days. We started at 1 o'clock on Wednesday, so I would estimate that the number of trades would have been about 45, 46, and I think the total pip slippage on that 46 or 47 trades was somewhere around 15 pips. So there is going to be some, and where that's going to occur is in a particularly fast market. So if I take a trade on the master account and we have a significant move really quickly, then there will be a certain amount of slippage. But based on the examples and the reconciliations that I've been given to date from individuals who've done that, the overall quantity, is definitely slip in both directions, some in your favour, some against you. But the total overall slippage in the accounts is quite minimal. 47, 48 trades, and probably 15 or 16 pips worth of slippage is not a great deal. And obviously a percentage of the trades that I take are in the Dow. It's more volatile, it does jump around. So if you get that, if you get a fast market or a jumping market, then you are going to see a little bit more slippage than you would normally. So I guarantee that there is slippage. It's not something at the moment, unless somebody wants to show me details that counter that, there isn't significant slippage. But please, as I've mentioned, the trades that come through on Telegram are direct from the master account. So that's the price of the trade that I take. If you see any slippage, then or any significant slippage, then please let us know. I'm out of time now. Thank you very, very much for joining us. We'll reconvene next week and have had a better week, I'm